Hello, Lenska Realty here. My name is Lenska. I'm a real estate broker and investment specialist, and this is San Diego Real Estate Market Update, June 2018. I also serve on the board of the largest investment club in SDCIA. So this market update is helping buyers, sellers, and investors because most of us use the equity in our home for wealth building. So wouldn't it be good to know what is happening in the market and not listening to the media hype and all that clutter that is on social media? Here we're looking strictly at the data. So yes, we would like to have the dinero, the green ones, the cash flow. So let's do no fortune telling, but fortune building. Don't forget to subscribe on YouTube for your next edition. In order to access a real estate market, we talk about 7 different numbers: the sales inventory numbers, interest rates, employment data, home purchasing sentiment by Fannie Mae, home builder sentiment, affordability, and usually we talk about the notice of defaults, trust deeds, but since there's no new update on those, we'll talk about my little Lenska investor deeds and tips for you to make even more money on your investments. Diving right into it, the San Diego County median sales price was at $650 for detached homes still. Notice that the appreciation has been slowing down. Also, same thing for the attached units. Median sales price is $421,000, a 7.3%, which is slowing down from about 11 to 12%, which we had in the beginning of the year. San Diego County attached for May, the average price per square foot was $409, which is a 9.1% year-over-year increase, which tells you that it is still going straight up, meaning that the more expensive homes are selling. Attached, we are laying around the $429 per square foot, which is now a little bit lower than the attached at 8.6% year-over-year. So we practically have exhausted the steep incline in the first 5 months of the attached units. The active listings in May were about 4,288 for attached units. As you can see, the low points were getting lower and lower, and the high points were also getting lower. So this looks like we might be just slightly lower, obviously only like 4% from last year. How low can we go? Obviously, the attached units didn't get any lower. We actually have an increase in inventory year over year. Active days on market, we're still going strong, about the 25 days on and the 21 days about on attached. We also noticed that interest rates were inching up slightly, but in the last couple of 2 weeks they actually leveled off. We still have the 30-year conventional fixed interest rate at 4.625, which means on a payment of $400,000, on a loan amount of $400,000, you're looking at a payment of $2,060 roughly. If you do qualify for the FHA or VA, VA is great because no down payment, and Your interest rate is 4.25%, which means you're under $2,000 for a payment on 400,000. Still, the 1099ers and the self-employed and anybody that cannot prove that they're employed, the interest rate is at 5.75. That hasn't changed. So your payment is about $340 more on this one. Jumbo rates are still pretty competitive, 4.625, and which gives a payment of $3,860. Unemployment is unbelievable strong in San Diego. It is at 2.9%, one of the lowest we have seen in the last 18 years, especially compared to the US at 3.9%. You probably noticed that every store and every office has a sign out, help wanted. And here we go into Fannie Mae's HPSI, which is the Home Purchase Sentiment Index. There are about 6 questions they ask every month about: is it a good time to buy? Is it a good time to sell? Do you think home prices will go up? Do you think mortgage rates will go down? Do you feel confident about not losing your job? And also, do you expect that your net income household is improving? The HPSI has risen 0.6 from April to May, and it is at an all-time high for the second consecutive month. And mainly because, and also that the household income is increasing, which I've been waiting for and saying for. We can't push those prices any higher unless people make more money, which you can see up in the Bay Area where we have quality jobs and they they have higher income. The prices also push higher. Now we do have a 14-point increase year over year. Good time to sell, but good time to buy remained at about 28. So we have right now that yin and yang pulling. Yes, it's a good time to sell, but even people selling less because they don't know where to move to. So the move up buyer market is pretty much shut down. Plus, a lot of people refied at 3.5% and enjoying their low mortgage payment. And here it will show you that this is what renters think. They don't have a very good outlook that they can afford a home compared to the homeowners. Homebuilders still think it's a great market, and we're coming up to 70, which is a pretty high level looking back to probably the 2000. It is only dampened a little bit about the tariffs and the high lumber prices. And to note, in the West, it is still at 76. Affordability is a whole nother story in Southern California. We just have received the first quarter 2018 affordability numbers, and San Diego remains at about 26%, which is pretty steady from also a year ago. It means that the median home price, which we just looked at, 610,000, you monthly payment is $3,160 and you need to make $126,000 to qualify. As you can see, San Bernardino is still an average like the average in the US, and Riverside also has some good affordability. Forget about Orange County, and Los Angeles is just a little bit above San Diego. The key points for the first quarter of affordability is pretty much that there are counties that remain flat, like San Diego, and we had a few counties that actually improved because they already have seen median home prices leveling off. So we had actually some declining home prices, and therefore the affordability improved. Also, some of it were the result of some subdued wage growth and price declines. San Bernardino, like we said, is still a very hot county to probably to invest and to build new homes because people can still afford it. Now look at the San Francisco, San Mateo, and Santa Cruz. All are at 15% and are the least affordable areas in the state. We looked at those numbers that the first quarter in 2018 compared to when we were at the bottom of the market. So these numbers practically tell us that the market has doubled and you need to make twice as much money in order to afford a medium priced home. How does San Diego compared to the rest of the country? We're around hovering about 14 least affordable out of all the states, and California's affordability is 31 and the US is 57. Remember, San Bernardino is at about 52. Now I wanted to share a few hot markets and ideas how to make some money. We have home flips hit an 11-year high in 2017. So we're about here, and these are the top cities: Nashville, Tennessee; Fresno, California; Palm Bay, Florida; Northport, Florida; Baton Rouge, Louisiana; Chattanooga in Tennessee; Los Angeles in California; and Lubbock in Texas. So you can see the cities are in Tennessee, California, and Florida. Anybody wants to move? Here the gross profits and returns. Now remember, gross profits doesn't mean this is your profit. That is the spread between you buying the property and then fixing it up and reselling it. Okay, and that is obviously US wide. And where cities become renter a majority population since 2006, we look right to San Diego, which is now a renter share went up from 47.9% to 53.4%, which tells us that the home ownership rate in San Diego is decreasing, which is an overall tendency right now in the United States. It's telling us we're having. So in order to create demand, we must have people who want to move into houses, which means we need to have and make babies. So look at the fertility rates in select advanced economies: the United Kingdom, Germany, US, and Japan. So I think Japan and Germany are in trouble. We don't have enough kids, and what does that mean? Homeownership in Germany is about 36%, so they already are a rental society, and they will have trouble fulfilling their Social Security obligation, same as Japan, but we're still below the replacement level here in the US. And I always liked this one, some food for thought about the wages falling since 1970 and profits rising since 1986. This is a percent of the GDP by Dent Research, because let's recall those hot days in 2006 when home prices were rising and allowing millions of homeowners to refinance mortgages and support the economy with about 300 billion in cash from their increase in appreciation in properties. So we pumped all this back into the economy. Now, forward 12 years later, it's happening again, but now we're seeing it on the corporate level that now they got some cheap debt and they had a one-time tax windfall to take out some cash out of their balance sheets to pay some more dividends. It looks like we're on another sugar high right now. We do have a already booming economy, and once again we're diverting some of that capital that we could do for future investments and taking an early profit. Will this head to another recession? Question mark, question mark, question mark. You always can join us at SDCIA. Check us out, and we have special events, special classes. The next one is on June 16 from 10 to 2, how to invest in tax sales. And for myself, I always like to educate people too. I had an event for about 10 years. It's called a rehab field trip. We meet on the third Saturday from 10 to 1. This time it will be a free event, June 16th, telling you about investment strategies for today's market. July 21st, I'd like to invite you to tour the Silvercrest Home Factory, which produces and manufactured modular homes there, and we're going to get a private tour. Please contact me. Don't forget to subscribe. Thank you for listening.